What's up, guys? Hope you're well today. Thanks for tuning in. Today, I want to talk a little bit about a couple of different types of income and their overall role in achieving financial freedom and ultimately long-term wealth. This topic is kind of a piggyback or really a deeper dive into a topic covered a couple of weeks ago. That post was titled "A Blueprint for Small Business Success," and you know, big picture, the goal of this content really is to give an example and kind of a description of a 50,000 feet foot overview of a strategy really for creating financial freedom and ultimately long-term wealth. Really within the realm of small business, honestly. But anyway, dive right in. First type of income I want to cover is earned income, and it's pretty straightforward. Really, earned income is just you know any compensation that you receive for the performance of services if you're in the service industry, or sale of product if you sell a tangible product. But so earned, you have dollar sign there. Again, it's for any labor you would your labor for services and or um, the sale of a product if you're like a retail, for example, or it could be any type of product. But this type of income is produced for those types of things just in the ordinary course of business. If you're an employee, your earned income would be the wages that you get every paycheck, every pay period. Self-employed would be, really the net income, the difference in the amount of total income that you made for a given period less your expenses. So, in this previous post, where the blueprint for small business success, I kind of simplified this topic or this concept, the concept of earned income, and it was described in terms of this would be your earnings from your primary business. So, for me, for example, I'm a CPA, so my primary business is providing accounting and tax services, and my earned income would be those billings, the revenue from those services less my expenses. This moves us right on along to investment income. Uh, that's Let's start with just the flat, simple definition of an investment. What's an investment? The dictionary, just looking it up online, and it kind of combined it to what I really see. The way I see it is, I would describe it as an asset acquired in exchange for money with the intended purpose of producing money or producing income. Excuse me. So, an investment could be any number of things. Let's just give a couple examples. Stocks or bonds that you buy, publicly traded, for the publicly traded stocks or bonds that you would buy through your brokerage account or in your retirement account. But an investment could be any number of other things as well. For example, real estate. It could be a commercial piece of real estate or a residential piece of real estate that you lease out to a tenant. It could be mineral interest in which you receive royalties in exchange for leasing your minerals underneath the surface of the land that you own. Uh, One other one could be a a or an ownership interest in a small or a privately held business. For example, you and you and your buddy have a or decide, your buddy comes to you and decides, hey, let's has an idea for to start this business, and he or she is going to manage it and handle all the day-to-day stuff, and your involvement is strictly going to be, financial backing in the form of, you'll put up some money on the front end in exchange for an ownership interest in that company, but you're not going to be involved in any of the day-to-day activity, managing, so forth. You're kind of a silent investor, if you want to say it that way, or a passive investor, and that could also be an investment. And so, investment income, that's what this topic here we're talking about. That would be some examples. Like I said, the first few, when I was describing investments, first few I said were stocks, bonds, and real estate. So investment income, here's an example of the income that you would receive from a stock would be a dividend. And the type of investment income from the second investment I listed or I named was a bond, so it would be interest income. And then the third was rental real estate, which would be rents, would be the income from that investment. So the royalties or mineral interest was the next one I mentioned, in which you in effect lease your minerals. You own the land, the surface, and then you in effect would lease the minerals and to the operator who comes over there, comes on your land, drills a well, and then you would receive a royalty in exchange for allowing that oil and gas operator, driller, to come out and drill the well and operate the well on your property. So these are two main broad types of income that I wanted to just go over briefly. Earned income, again, that would be the money from your labor, money from products, money from your labor and or products that you sell in the ordinary course of business. And like I said in the previous post, how I described that would be, these are the earnings from your primary business, whatever that may be. For me, it's being a CPA, it's my CPA services for preparing tax returns and doing bookkeeping for clients and consulting with them, so on and so forth. Investment income. We just went through a number of examples. Basically, an investment's an asset that you pay for the intended purpose of producing income. Various types of investments that produce various types of investment income. And to bring it back to the post that I made, the previous post of a blueprint for small business success, that these types of investments would represent a secondary business. It's commonly referred to this day and age as a side hustle. That's what a lot of people, kind of the cool term for it this day and age, but I really like to think of it as a secondary business in which you are not required to actively manage it or be involved in the day-to-day. However, you do have some kind of stake in the business and in the ultimate income, net profits or losses, deductions from that activity. And so we talk all that just to bring it home to this point, and that is, how do we combine these two types of income, earned income, investment income, to achieve financial freedom and create long-term wealth? And there's any, unlimited probably number of ways that could be done. But the way I like to think about it, really, in my philosophy, I guess you could say, is, but it's not just mine, but how I like to describe it anyway would be, okay, so your earned income, you got your primary business. That's where you're involved in the day to day. You do all the work. You actively manage it, actively do whatever the hell it takes to do to make money. And then from these earnings, upon getting to a certain point where you've got a certain amount of cash flow, you're comfortable, the income and the activity, the clients you have, the employees you may have, the things are consistent, things are steady, predictable, and you're making money enough to the point where you can take some of the earnings from this primary business of yours and divert it to what I'm calling a secondary business or an investment, basically, that produces investment income. Again, it could be any number of the things that we talked about earlier. It could be stocks and bonds. It could be real estate. It could be mineral interests. It could be CDs, money market accounts at a bank or financial institution. However, again, where I guess you could say I'm customizing or my philosophy, and based on also what I've seen working with successful and financially wealthy people over the course of my career, is an overwhelming majority take take a portion of their primary earnings at some point, invest it in a secondary business, and this secondary business overwhelmingly it's just amazing how consistent or how common it is. This secondary business generally or oftentimes is some form of real estate, and there's a reason why it is very common for these successful people to have a portion of their earnings invested in real estate, and the main reasons are the passive nature of real estate, meaning you don't have to spend a whole heck of a lot of time, managing it or making decisions on a day-to-day basis. It can be bought, purchased, fixed up. You find a tenant, have a contract, lease agreement with them, and then collect a check month in and month out, which leads to the second point of the cash flow produced from the rental real estate is both consistent and predictable. These two traits are just unbelievably important. It could be easy to overlook, but they're just amazingly important. The consistency and predictability, reliability too, as you say, of the income produced from rental real estate, because knowing the income being consistent and predictable allows it enhances your ability to reach a point of financial freedom and ultimately to a point of long-term wealth. But we'll start with financial freedom. If every month I've got X amount of dollars coming in on this secondary investment. Remember, secondary investment, I don't have to spend hardly any time on a day-to-day basis dealing with it. It's just there, and every month I know I'm getting X amount of dollars from it. All the while, I can maintain my focus and energy up here at the primary business level, doing what needs to be done up here to continue to generate earned income, and then this cycle really repeats itself. Again, you reach a point where you've got some extra, or you're able to divert some income, or some of the earnings from your primary business into another secondary business, in which you don't have to, in this, it doesn't have to be real estate every time, but like I was saying earlier, and that is with the financially successful clients I've worked with, it's astounding how many or how common it is amongst them to have investments. A lot of them have significant amount of investments in real estate, income producing real estate, mind you, not just any piece of real estate, but real estate that has enough value to other people that they're willing to pay to use it, live in it, whatever it may be. And anyway, so again, this cycle can be repeated over and over and over, and build up. Or for starters, like we said, it helps to reach financial freedom, knowing every month I'm going to have X amount coming from this source, even though I don't have to do anything, really to work at it or to take care of it, to manage it. It just is going to be there. It's mailbox money. It comes, I go to sleep at night, and it's going to be there the next day, regardless. And so that cycle can be repeated over and over and over. And if you repeat it enough, some of the other wealth generating factors of real estate ultimately start to kick in. One of the main ones being appreciation. Real estate is one of many is one asset that has a magnificent track record of appreciating over time, and we know that they're not making any more land. That's not going to, the United States is what the United States is, and there's not going to be more of it. So it's a finite resource, and it's probably going to continue doing that for the rest of time. So you've got that kicks in. You've also, like we just talked about earlier, we've got the cash flow. That's the main one that really, in my opinion, helps you achieve financial freedom. And then you got your third, which would be paying down any debt. Oftentimes, this leads actually into one more good side point and another great reason why real estate is such a common investment for secondary purposes of successful people, and that is access to capital. Real estate is amazingly, it's an amazing asset in the sense of you can buy a very inexpensive asset with very little amount down when you purchase it, at least in proportion to what it costs. For example, $100,000 piece of real estate that you find that you want to buy, many oftentimes just being conservative, really, depending on the specific of a deal, could be better than this. But the bank's gonna require that you put down at least 20%, and so we'll just go with that number. So for this $100,000 piece of real estate, all you gotta do is come up with $20,000. Which, yeah, $20,000 is a lot of money, yes, but income, putting up that kind of money to own a asset worth 5 times that much, that's pretty significant. And compare that to another type of active business or something. Like, let's say your primary business, instead of diverting some of those earnings and putting it into real estate, let's say you were going to divert it to start another business. Well, go to the bank and ask for a loan or working line of credit, for example, on a new business that's just being started, being created, and then go in the next day and ask the same banker for a loan on a piece of income-producing real estate. I'd be willing to bet 10 times out of 10 you're going to be able to get that loan, the second loan, the loan for the real estate, a heck of a lot easier, and probably and just a heck of a lot easier, and just it's possible, not only possible, but it's probable that she'd only having to put up around 20% of your own money to get an asset that much. It is a much higher probability that you'll get that, be able to secure that loan from the banker, versus if you needed $100,000 to start a new business that was going to require your active involvement. It was going to cost you $100,000, and you went to the bank and said that, hey, I need this, and it'd be almost no way that you'd only be able to have to be on the hook for put up $20,000 of your own to have access to a $100,000 line of credit, and no other collateral or whatever. Whereas that is very not only possible but happens all the time, and it's pretty much anybody, I don't want to say just anybody, but it's just a hell of a lot better odds that you're going to be able to get access to this $100,000 piece of real estate that's going to produce however much, 15 or 20,000 in income annually versus $100,000, line of credit or whatever to start a new, brand new, actively managed primary business. So, all that to say, all that back to in this where this third factor this third factor of real estate that leads to long-term wealth is over time you're paying down that debt every month. You got to make your note payment to the bank, right? Okay, well, so a certain portion of that goes to principal, a certain portion goes to interest. Well, over time, every monthly payment, more and more and more is going to principal, and so that's another huge factor that leads to long-term wealth from real estate. And the fourth wealth generator from real estate is the tax benefits. And I'm actually not gonna be going into any detail on the tax benefits topic today because I've actually got something coming up. I'm going to do a whole new post for the tax benefits from real estate. That'll be coming up probably next week, so stay tuned on that one. We'll get into that. It's real important, and there's a lot of different things that need to be discussed, and a lot that you can learn. But so to recap, your primary business, you earn money from it. At some point, you're able to divert some money to a secondary business. And so I wouldn't say suggestion, but what I'm a big proponent of, big fan of, would be that secondary business being involved in real estate, particularly rental real estate of some form, where you're able to buy some real estate, maybe put a little money in it to fix it up, get it to the point, and then find a tenant, get you a good solid lease agreement with that tenant, and bam, then you've got X amount of dollars, $1,500, $2,000, $3,000, $4,000 coming in every single month, with very limited involvement on your part, or in order to get that, so you're able to continue to manage and be actively involved in your primary business. And then, time goes by, you're all the while, getting that cash flow every month. As more time goes by, the appreciation of the property starts to kick in, the debt starts to go down, and all the while you're achieving or receiving those income tax benefits. So, bam, you're achieving financial freedom, and slowly but surely, you're ultimately creating long-term wealth. And again, as more time goes by, the goal would be, eventually you're able to divert a little more to a new secondary business or another piece of real estate, and on and on and on, or the process can repeat itself as much as possible if your goal is to achieve, maximize your earning potential, and ultimately your long-term wealth, the financial security of you, your family, and for generations to come, really. So anyway, that's about that. That is that. And if you guys have any questions or concerns, comments, anything, please feel free to drop a comment below, or hit me up on my blog, or send me an email. I'd love to talk with you in more detail if you have any questions or anything at all. Take care.